Welcome to our NDIS podcast from RSM Australia.
The National Disability Scheme, or NDIS, is a national scheme that provides direct funding for people with disabilities to access services and supports to live and work. In this episode, we'll explore the financial risks of NDIS providers and discuss how you can mitigate them, as well as the less well-known risks and challenges with the NDIS and GST. So listen in and join us as we explore the financial challenges of being an NDIS provider. Welcome to our NDIS podcast. I'm Kirsty McGovern-Hooley, and Louis Carney is with me as we co-host this episode. I'll start with a little about me. I have worked with NDIS providers on business transformation, financial modelling and benchmarking for the last 10 years, and as part of our business advisory team in Canberra. Today, I have Louis Carney with me, who is an indirect tax specialist based in Brisbane. Louis, would you like to introduce yourself?
Thank you, Kirsty. As you say, I'm Louis Carney. I'm an indirect tax specialist with more than 20 years experience in both Australia and internationally, and amongst others, helping not-for-profit organizations with VAT and GST systems. It's lovely to partake in this podcast with you today. Now, Kirsty, to kick us off, as the NDIS specialist, can you give us some background on NDIS businesses and what the sector is facing?
Yes. NDIS providers are organisations, companies or individuals that deliver supports and services or products to participants of the NDIS. That's people with disability. So providers are the front line in enabling people with disability to live their life, and they play a critical function in supporting people to participate in our community. Like any business, NDIS providers face financial risks, including cash flow, market competition, regulatory changes, operational challenges. There's been a lot of recent public discussion and government measures introduced that focus on managing the overall costs of the scheme to the country, and this translates into a lot of financial pressure on providers. Simply, the scheme is projected to cost $60 billion by 27-28, which is 20% growth on the current costs. It's very important to the government, I think to all of us, to control that growth in expenditure. While there are many factors that affect this growth in terms of the different types of plans and how plans are spent and how the money is allocated, naturally there is a very strong focus on prices, because a small increase in price translates into billions of extra funding. So there's very calls to increase the price by 10%, but that actually will drive really significant growth through the whole scheme. So the commercial pressure the government is placing on the industry to keep costs down, and they're doing this through very significant programs around eliminating fraud, is very significant. For example, my child is an NDIS participant, and I just received a personal letter, my daughter just received a personal letter from Minister Shorten asking me to report any concerns that I had with provider pricing. So it's very front and centre and very part of the public narrative. Yep. However, we also know from benchmarking and other reporting that 80% of NDIS providers are in financial difficulty, and disability providers have one of the fastest growing rates of insolvency this year.
Oh, that's very interesting, Kirsty. Thanks for that. Now, from the outside, there's over 40 billion being spent on supports. With all this available funding, why are providers in financial difficulty?
I understand the scrutiny on prices. There are, and certainly the focus on fraud. There are some segments and operators who take advantage of participants either unintentionally or deliberately. There are many market factors that impact pricing in some segments. For example, workforce shortages are driving prices up for some services a lot higher than they need to be because they're so restricted in supply. However, all of that public narrative overshadows some of the structural problems in the pricing of supports themselves, and this needs review. The NDIS is funded as a fee for service, so there's a fixed price for every hour of service. It's based on the NDIS cost model, which has very, very tight assumptions, and they leave no room for anything less than very, very high thresholds of productivity and efficiency. It's a different way of funding this sector. In the last 10 years. So instead of getting a large lump sum of money or a grant funding, the provider is paid a fixed price per hour.
That makes total sense. Now, as a taxpayer, I want pricing to be efficient. So can you break down for us some of the challenges with pricing?
So the NDIS price is based on a methodology called activity-based costing and unit costing, and it derives what's called a unit price. So that majority of that $40 million budget that's spent next year is spent on support workers providing assistance. And there's many different types of assistance that they provide, but predominantly the fixed price is $65.47, or the maximum price is $65.47 per hour.
Yep.
It sounds like a lot, but when I say this is tightly modelled, the assumptions are published about how they've derived that price, so we can understand and we can benchmark against all of those assumptions. The margin or the profit or surplus in the NDIS price is 2%. So other sectors and other businesses will operate at substantially higher margins. Your retail margins are higher, for example. Now, we don't want a profit-driven NDIS. However, out of that $65.47 price, the provider only keeps $1.31, and that is to pay for. It's not essentially that can be taken as profit, but really what you're looking at in the business is for that to be then reinvested back in the business in systems and technology and all the other things that they need. The other reason why you want to make a reasonable surplus is that you want to have room for challenges or problems or changes in market conditions, or if something suddenly, if your business suddenly changes.
Yep.
And so what that does is it leaves providers with very little room to fix problems if they come up very quickly. And when you combine that with very high productivity and efficiency benchmarks, businesses will find it very, very difficult to build sufficient financial reserves. When I talk about the productivity and efficiency benchmarks being very high, if you take that $65.47 rate, once you take out all the wages and on-costs, that leaves $18.83 each service hour for a business to cover all their costs. The productivity expectation is very high. A support worker is expected to have a 92% level of productivity. That is 92% of their time will be chargeable or spent face-to-face with participants. And that leaves insufficient time for training and administration. So when you sort of break that down, it translates into 3 minutes per hour for a worker to have a bathroom break and to complete the administration and the reporting that they need. It's very, very high. And another key assumption is that overheads will be 12% of direct costs or wages. And so this can work two ways. At a very small scale where you may not have an office and you're working out of your house, your overheads are not very high, so it can be a lot more affordable. But at a very large scale, you've then got enough volume and scale to be able to get your overheads down to a certain level. But when you're in a medium level, and by this we're talking 10, 15 million turnover, that's very, very hard to keep that down. And in most businesses, anywhere up to that sort of $10, $15 million level are operating at around a 30% overhead. So and to try and get that down any further is also, the cost model does not factor in important business costs, which include compliance and training costs, taxes such as payroll tax and GST, because as we'll talk about in a little while, it's meant to be GST free. So overall, the cost model is a really tough for most businesses to meet, and it's very easy to get into financial difficulty.
That's very insightful, Kirsty. Now, what kinds of financial issues do we see or impacts on businesses?
Generally, when we start working with a provider, we'll look at their costs, and we find that their costs are more than the hourly price to deliver services. And this could be due to a range of different factors depending on the business and the conditions that they're operating in and the market that they're in. It could be due to higher wages. They may have experienced staff that are very well entitled to a level 4 pay point in their wages, but the average cost model only funds an average of a level 2.3 worker. So we had one business we worked with whose wages costs were 1.2 million and they were getting revenue of 800,000. So you can immediately see the problem there. But the difference was largely due to their paying higher wages. Now they had wonderful experienced staff that had been with them for a very long time, over 20 years, but they couldn't afford to continue paying them to do that particular job under the cost model. And it could also be as a result of not meeting the productivity and staff utilisation rates. So it's not unusual for us to work with business who can't get anywhere near the 92% utilization. They could still be sitting, I've seen as low as 35 or 50%. And if you break down to numbers, that means for a full-time employee, that person is costing you $46.64 per hour to employ. And that is looking at that. How you break that down is you take their rate that you're actually paying them. You then have to then work out all of the time and the leave and all the other things that you still have to pay. So when you break all that down and you multiply it and divide it back, it costs you $46.64 to employ them. That's all their super and everything else. Every hour they work where they don't earn a chargeable NDIS fee becomes a loss to the business. So at 50% productivity, that work is actually losing the company $163.24 per day in wages costs. And the profit you've earned on that day, or the surplus, is $3.93. So you can start to see the problem for businesses with managing fee-for-service funding if your utilization is too low. In the worst case, I've seen businesses chase volume or services hours, believing that more revenue will fix the problem, but instead they grow their loss. So, we've seen businesses that were doing $50,000 loss suddenly turn into $300,000 or $400,000 loss in 3 months because they chased volume, added staff, added the inefficient structures underneath it. And so now, congratulations, you've got a much bigger business and you're making a much bigger loss. The other thing we see is that any fine or levy that was unexpected, like a workplace incident, staff losses, anything you need, like capital investment, cybersecurity breaches, all of those types of events can be quite catastrophic to a small NDIS business because of the financial impact of that on their cash flow. In recent times, we've also provided some support to businesses who've run into tax problems. We are certainly finding and we're not the tax experts, but we're finding that those tax implications are not well understood generally by the sector. We've worked with some really energetic, very fast-growing social enterprises who are honestly doing some fantastic work, and then they haven't realised they've hit the payroll tax threshold. Suddenly they're facing quite serious fines from their state, to rectify that. And we're also starting to encounter some GST problems. So very early on in the scheme, there were very few determinations that had been made, and it was very much, people were not thinking about GST at all. So we understand that the scheme generally, disability sports are exempt from GST. But there are some financial mines that NDIS businesses need to be aware of. So Louis, are all NDIS services GST free? And if I'm running a social enterprise and I own my own company, what should I be aware of? What should I be thinking of?
Yeah, great questions, Kirsty. Now, well, the legislative framework certainly allows for NDIS supports to be GST free or exempt, as you say. But as the cliche goes, that the devil is in the detail. Now, to take a step back, for NDIS suppliers being able to classify their supplies of services to a NDIS participant as GST free is like winning the lottery. So that is, the NDIS supplier is not liable for any GST on the revenue it receives for its supply of NDIS services, and it's entitled to the GST credit for the acquisitions that it makes for those supplies of services. Now, to quickly run through the main criteria for a NDIS supplier's supply to an NDIS participant to be GST free, all of the following conditions must be met. There are 4 conditions here. So number 1, the NDIS participant has an NDIS plan in effect. So what does that practically mean? That the NDIS supplier should preferably cite the NDIS participant's plan to confirm that the plan is effective and that the participant's eligibility and the nature of the approved disability support. So number 2, the supply is of a reasonable and necessary supports that are specified in the statement of supports in the participant's NDIS plan. So what is that? That is, the supplier's supply will only be eligible for the GST-free concession or treatment to the extent that the nature of its supply is specified in the NDIS's participant's plan. And number 3, there's a written agreement between the NDIS supplier and the NDIS participant or another person. And again, practically, the written agreement must identify the NDIS participant, and it must state that the supply is a supply of one or more of the reasonable and necessary supports which are specified in the statement included under subsection 33, subsection 2 of the NDIS Act and the participants' NDIS plan. And the last criteria is that the nature of the NDIS supplier's supply is of a kind that is specified in one of the two tables in the NDIS determination. Now, typically, those examples would include specialty disability accommodation or accommodation tenancy assistance, household tasks, assistance with and training in travel and transport arrangements, but it excludes taxi fares. Now, it's also worth noting that if a particular NDIS support does not qualify for the GST-free classification under the NDIS provisions in the GST Act, it might qualify for GST-free treatment under another provision of the GST Act. For example, a supply of care is GST-free if the supplier receives funding under the Home and Community Care Act 1985 in connection with that supply. So where the service itself runs at a loss or is charged at below market value, it might also be GST free. However, this concession is not available to all organizations, so it's best to have this exemption confirmed upfront.
I think what I'm hearing from you is also how important service agreements are, and making sure that your participant service agreement is signed and up to date and includes those appropriate clauses, because that's the best way that you can demonstrate that the services you're providing are GST free.
100%.
So how does this work if I'm operating a not-for-profit? What should I be thinking about? Because it's a little bit different in terms of its structure and tax.
Yeah, that's right, Kirsty.
Yeah.
I guess so. From a GST perspective, I would say that the NFP should firstly consider its entitlement to register for GST. So the GST law states that an NFP's GST registration obligation only arises when its GST turnover exceeds $150,000 in a 12-month period. However, not many people know that you may elect to voluntarily register for GST. So being GST registered will allow the NFP to access the GST credits for its acquisitions. The next important thing for the NFP is to consider its revenue mix and to classify the underlying supplies for GST purposes between taxable, GST-free, input taxed, or outside the scope of GST. So getting the classification right ensures that the GST is only reported on taxable supplies and not on the rest. So for taxable and GST-free supplies, the NFP is entitled to full GST credits on its related acquisitions. So although the NFP is not liable for GST on any input tax supplies, it is also not entitled to GST credits on related acquisitions. So for example, supplies of residential accommodation at more than 75% of the market rate or cost to the provider is input taxed, and the supplier is not entitled to any GST credits on the related construction or operational costs. Now, in the space of classifying the NFP's revenue mix for GST purposes, we often see that donations or sponsorships are not treated correctly for GST purposes and by default classified as outside the scope of GST. It's critical that NFPs consider the obligations it takes on when concluding a contract for a donation or a sponsorship. So if the payee receives a direct material benefit from the NFP, for example, the NFP agrees to advertise the payee's name on its website, then the monies received might be consideration for a taxable supply, and the NFP could be liable for GST without a mechanism to recover the GST component from the payee if the contract does not contain a robust GST gross up clause.
That's really interesting to understand, because I don't think a lot of businesses necessarily consider this when they're going after additional revenue through sponsorships and in-kind arrangements.
Yeah, almost back to what you were saying, the importance of contracts and putting things in writing, making sure you dot the I's and cross the T's. Yep, 100%.
Yeah. So how can businesses mitigate some of the financial risks of GST and some of the other factors we talked about today?
Well, Kirsty, for businesses to clearly understand whether they are liable for GST or not on their supplies is absolutely critical. So Also, what the entitlements are to GST credits for the acquisitions are fundamental to business planning and modeling. So because of the specialist nature of the GST exemptions and general compliance, I would also strongly recommend seeking professional tax advice on the availability of these concessions, as this might improve net revenue and increase overall compliance, which will reduce the exposure to penalties and interest, which you alluded to earlier.
I feel like there's so much focus on the registration compliance and quality and safeguards compliance. One of the things we also need to really look at is financial compliance with, particularly with your tax. So I think that's really useful. In business advisory, we would work with a client to, we would be looking at the overall business to benchmark the business performance against the cost model. And identify the issues that's specific to that particular business, because they can be very different depending on the context and the types of services that they're offering. And we would work to improve the business model and the structure of the business, and we provide support to implement the changes. We would usually then work on implementing digital infrastructure to provide management with some of those key metrics in the business to be able to easily monitor and manage and track that performance. So at RSM, we have a data analytics division, digital advisory and ERP advisory teams that, depending on the size, scale, scope of the business, can all assist. At times we find that the investment or the appetite in the business to change is not there, or that the solution sometimes is substantially increasing scale, in which case we work with our corporate finance team on either seeking investment or mergers or acquisitions, or we look very hard at either transitioning part or some of the business for sale. And we also work with our RSM recovery and restructuring division if insolvency is a potential issue, because the earlier you can intervene in that, the more options you have. So my best advice is you really need to treat your NDIS business almost like it's retail. It's you need to be checking your financial performance frequently, looking at all of the different metrics in the business around staff utilization, weekly, fortnightly, and seek help early if you're running into issues. Have a very well detailed and planned growth strategy. There is so much demand in the NDIS, it's very easy to just keep adding hours if you can get the staff to support that. And that's where we find businesses run into difficulty, because their growth is so rapid, it's very, very hard to keep up. So again, I would recommend, coming and talking to us and getting some advice, getting some financial models in place, and working out how we can support you to grow.
That's good advice, Kirsty. And
yeah.
We appreciate your participation in this first NDIS episode. We hope that today's dialogue was meaningful for many of you who listened. So keep an eye out for our second episode coming soon on compliance and regulatory requirements for NDIS. Thank you very much.
Thank you.
Keep tuned and join us for our next episode as we explore the financial challenges of being an NDIS provider. For more information, visit us at rsm.com.au.